Good morning, you're watching One News Now Markets. I'm Dani Laurel. Now, before we delve into the equity space, here are the top stories of the hour. On the first day of the nationwide transport strike, various transport groups flocked to the University of the Philippines, Diliman, to stage a protest against the jeepney modernization program. For more updates, we have with us mobile journalist Pamela Vasquez joining us live from Quezon City. Pam, what do you have for us?
Hi Dan, today is the first week of the week-long transportation strike, and various transport groups, together with jeepney drivers and operators, chose to spend the day here at the University of the Philippines to hold a protest against the impending jeepney phase-out. The protest is led by Piston and Manibela. Piston says around 80% of PUV routes in Metro Manila is already paralyzed because of the transport strike. Meanwhile, Manibela said 10 routes per city are affected. That's also 60 units of jeepneys per route. Their call, no to jeepney phased out. Manibela said that while they do not oppose the PUV modernization program, they want the provisions more clear and fixed and should not compel individual drivers or operators to join a cooperative or to buy modernized jeeps, which cost around 2 million pesos per unit. They said that by extending the deadline, they are only extending the suffering of jeepney drivers. Meanwhile, several schools have already shifted to online classes for this week. LGUs have already deployed vehicles for their Libreng Sakay program to ferry commuters on selected routes. Danny from UP, we traveled here in Moraita, Manila, and while traveling, we have noticed that only a few jeep units are indeed plying the roads. But some groups like PEDJUDAP have not joined the strike because they do not want the commuters to suffer. As for the commuters' sentiments, some said that it is a hassle, but many also understand the drivers' and operators' sentiments. Danny?
All right, thank you so much for those updates, Pamela Vasquez. Inflation likely accelerated further in February off of the back of higher food and cooking gas prices. A Business World poll of 17 analysts yielded a median CPI estimate of 8.9%. Now, if realized, this would be faster than the 14-year high of 8.7% in January of 2023. The Bangko Sentral had earlier projected February inflation to have settled within 8.5% to 9.3%. Economists say inflationary pressures likely remain strong in February due to elevated food prices and an uptick in the prices of LPG. The February inflation data will be released tomorrow, that is March 7th. And the local bourse reiterates its push for short selling in a bid to beef up liquidity. PSE President and CEO Ramon Monzon told the Philippine Star that short selling would encourage foreign investors to stay. Monzon said short selling should be seen as a hedging tool and not a speculative tool. He explained that with short selling, foreign investors do not have to sell out, but can rather hedge, and in this way, the funds will not go out of the local bourse. Short selling is still awaiting approval from the SEC. It's a whole new trading week with most of our 2022 earnings having been reported and where to position right now. We have with us Ron Acoba, founder and chief investment officer of Trading Edge. Welcome back, Ron. Can you come off of mute, Ron?
Hi, Dan. There. Thank you for having me.
All right, let's kick off with the index, no, and this inflation print for the month of February, whether that has already been priced in at these levels. We did see a bit of a rebound, at least last week.
Well, I don't think the likely increase in February inflation is already priced in the market. In fact, going back to the previous month's print, not a lot of economists and analysts were expecting a sudden jump or a continued jump in inflation. In fact, a lot of them are expecting inflation to have improved already. So with the market generally being caught off guard, at least in the previous month. So I don't think that they will be really positioned ahead of the probable increase in the inflation figure for the month of February.
Okay, so you still see some downside risks, no? I'm going to pull out this chart for you.
Definitely, yeah.
Yeah. Give us the momentum that's going on here. No, it's really up and down. We cross above, and then now it seems that
Yeah.
we're down. Where is this headed, Ron? Even in the short term.
Well, in the short term, well, generally speaking, the market is opening on a positive note. Now, that's because of the 1.6% rally that the S&P 500
Okay.
index performed last Friday. But as you've mentioned, there remains to be some further downside risk from a technical perspective. The index's inability to stay above its supposedly key support at 6.8
Okay.
places a lot of downside pressure on the index. But generally speaking, if you look at it from a 1 year perspective, much like what we have in your chart now, it's more on a general sideways. So there's index is basically directionless. So
Okay.
what this tells us is that investors are generally awaiting their direction, perhaps, and not perhaps, in my opinion, from the from inflation generally, because for the past year or two, inflation is the one that's been the major catalyst of market direction. So with inflation, for example, let's say inflation goes higher again for the month of February, which will be released tomorrow. Then we'll continue to see some
Okay.
choppy movement with the downside tilt. On the other end, if inflation shows some degree of improvement, then we can see perhaps some uptick. It's only when we see a successive months of improved inflation that perhaps the index will be able to see some upside momentum.
Okay, what is the psychological support level, psychological ceiling that we're now seeing? Because, like you mentioned, it was 6.8. Is it now below 6.5? We've broken below
No, no.
that. Is there a level where people start buying
the support
in?
The key support now that we're looking at is the 6.4 level,
Okay.
and the key resistance that we're looking at is the 7.1 level.
Okay.
So for the index to really have a more sustained rally, the index has to clear the 7.1 high. On the downside, a decline below the 6.4 handle places the index en route back to its 5.7 low.
Okay. Give us an idea of stocks that we should be looking at given this type of trading. Like you mentioned, directionless. Are there sectors that you are looking at? Should we be looking at defensive names, at cyclicals?
Generally, if I'm to look at sector, one that is outstanding that I might say is the banking sector. If you look
Okay.
at how BDO, BPI, Metro Bank has been performing, they remain to be somewhat resilient. In fact, they're trading near their 52-week highs. So, as you know, with the higher interest rate environment, despite a likely slowdown in loan growth, they will be able to make up for it with an increase in net interest margin. And it's because of this that these banks are able to buckle the market's general weakness.
That's a good question, no? Because we've seen that you see in my chart here, banks up by close to 12% already year to date.
Yeah.
How far are they from, let's say, the pre-pandemic levels in terms of
Still very
bottom line
very
and
far,
performance?
because historically, pre-pandemic levels, for example, the likes of BDO, BPI, and Metro Bank had been trading at a valuation of, say, 3 times price to book.
Okay.
As of present, the banks that I just named are just trading half of that. So
Wow, yeah.
there remains to be a good upside, relatively speaking, if you look at how they were performing on back on the pre-pandemic levels.
But from a fundamental perspective, Ron, when you look at the earnings, are they back to pre-pandemic levels? Have they made bawi, let's say, what they lost in pandemic?
I think not yet, because loan growth hasn't hasn't really accelerated yet because
Okay.
of because of the increase in interest rates in the past year, and earnings have been weighed down by provisions on losses on loans. So it's only perhaps in the present year and in the year forward that these things will normalize.
Okay, let's talk about some stocks that you gave us before the show that you're looking at. One is Century Pacific
Yeah.
Foods, no? Interestingly, like you mentioned off air, this hasn't moved as volatile as the rest of the index or the markets. Give us an idea of why that is and why you're looking at this stock.
Well, I'm looking. Given that the market has been performing very poor as of late, us traders, as investors, though we like to position on the stronger names aside from the banking sector, which I mentioned a while ago, which has performed and buckled the market's general weakness. Other names such as CNPF has managed to become resilient as well. Technically speaking, the stock has just been trading within a tight range below the 26 or just around the 26 handle. So it basically means that investors are
Sticky.
slowly accumulating the
Okay.
stock, and there aren't much selling on it. That's why it's failing to see some major drawdown. So, which tells us that perhaps insiders in the know are positioning perhaps for a likely acceleration or improvement in earnings growth in perhaps in the coming quarters.
Okay, so one to watch out for there, some sticky investors and also those slowly accumulating as CNPF trading at 25 pesos and 90 centavos. Thank you so much, Ron Acoba, founder and chief investment strategist over at Trading Edge. Thank you, sir.
Thank you, Dan.
And that's it for this hour. I'm Danny Laurel. Join us again at 11:15 a.m. We are One News, all sides, all the time.